Morning, it's Friday, 7:30. It is Non Farm Payroll Day. Thanks for joining me. Yesterday we had an ADP number, I think it's called ADP, number out of the US. It's sort of a private sector employment number, not usually very important, especially as it comes out. I think it always comes out the day before the Non Farm Payroll number. So it comes out the Thursday before. The Non Farm Payroll number always comes out the first Friday of the month. And it had quite a dramatic effect. Strong employment number, that one, and it really caught the attention of the market. Really pushed the dollar significantly higher. So there's me saying I didn't expect a lot to happen before the non-farm payroll number, and we really got quite a big move. It particularly affected the Aussie dollar, the New Zealand dollar, the euro, and gold. So let's have a look at some of those. We've got the Aussie dollar up here now. So the fact that we dipped yesterday really sort of increases the chances of this head and shoulders pattern forming. I've been talking about this for quite a long time now. It's a big pattern, and if it does complete, it really is very significant. We'll follow it still. With the neckline is a long way down here. It's below the 200-day moving average, so we've still got a long way to go. But there's actually sort of this is an unusual situation. I don't quite know how to read it, if I'm honest with you. We've got a more minor head and shoulders pattern here. Can you see that? If I just kind of do this, then we should see it more clearly. I can't disregard it, but I kind of don't really know what to do with it because it's a head and shoulders pattern. You often get head and shoulders patterns within head and shoulders patterns. That's not unusual, but you don't get one next to a head and shoulders pattern. You don't get a head and shoulders pattern being the right shoulder. Let me try and explain this. This clearly does look like a head and shoulders pattern. So we've got the shoulder, the head, the right shoulder. There's your neckline. That's the lower trend line. And it's been broken. So when you take that on its own, you say, yep, there's a head and shoulders pattern. It is at the top of a significant upward move, and so therefore it is relevant. But it's kind of weird because this head and shoulders pattern is the right shoulder of this bigger head and shoulders pattern. Anyway, I'm going to count it. I'm going to say that it is an important head and shoulders pattern, and I'm going to say that it is giving us a more negative outlook. Now, of course, we need to close the week below the neckline. We've got the non-farm payroll number today. So if that were to come in, if the non-farm payroll number were to come in weak, it would lead to a weaker US dollar, and then this market would be back up above the neckline, and then that would have been deemed to have failed. So we're kind of lucky that it's a Friday, it's a weekly close, which, as you know, I always say is more important than a daily close. So the close today really is important for future direction. Anyway, so if we break below there, then we could be looking at a test of the neckline down here. So at the moment the market is quite negative. If we hold sort of 76, 75, 76, 85 in the Aussie versus the US dollar today. What else can I say about that? Not really much, to be fair. But it's kind of interesting. Now, I actually want to elaborate on that. What I said before was you often get head and shoulders patterns within head and shoulders patterns. Now, what I mean by that is you'll often find, for example, that the head is actually a head and shoulders pattern. Now, that's not uncommon. You'll get a big shoulder, then you'll get a head. But when you zoom in on the head, for example, when you look at it on the hourly chart, you'll notice that there's actually a small head and shoulders pattern within that head. And that really gets quite exciting because it just shows that there are patterns upon patterns showing that the market is likely to reverse. And they play out beautifully. I've seen that before often. I hope we get to see one of those in the near future. Okay, let's stick with the dollar pairs, especially as it's non-farm payroll number today. So yeah, I wasn't expecting much, but we've got quite a big reaction in the euro against that ADP number yesterday. So I'm now starting to wonder if this is a double top pattern. We had a double top pattern in cable, and that's kind of working out nicely. Now, it wasn't really close enough. The peak here was at 122.64. It wasn't close enough to 123.50 for me to really count it as a double top. But some may argue that it is close enough. Anyway, the point is we have got a potential double top pattern. I've been warning for a long time about a trend line and we rejected it. Actually, the trend line was actually a 6-month trend line, which, oops. Well, anyway, it came in a little bit further along, sort of around here. I've taken it off now, but you'll remember I've talked about the 6-month trend line. So it wasn't a surprise that we topped at around 122.60, 122.70. I had been looking for that to happen. I must admit, I'm quite surprised at such a strong reaction yesterday. I didn't expect it to yesterday. I thought it might come today. Now, I had good support. Actually, I actually need to show you on the 4-hour chart. I had a very good support level at 121.40, 121.30, and I did think that would hold yesterday, bearing in mind I wasn't expecting a strong reaction before the non-farm payroll number. Now, that level has been broken. It is a big level. And do you remember me talking yesterday about why it was such a good level? If I remember correctly, we had some swing highs up here, which we needed to take note of. No, we didn't. Let me go back to it. It was basically the fib, a 23.6% fib, a small swing high up here, and the 200 period moving average on the 4-hour chart, and it had held so well before when we didn't have the 200 period moving average acting as an extra support level. So the fact that it's broken, I think, is very significant at the moment. Now, again, it all depends on the non-farm payroll number today. We could be back above there if that comes in weak. But 121.30, 121.40 is definitely the level to watch. Now, you can see on the 4-hour chart, we have not been able to get back above that level. It clearly is acting as resistance, exactly as it should do. When a strong support level has been broken, you assume it will be a strong resistance level, and that is what is happening now. So we're actually backing away from that level as I speak, creating a new low. So that's playing out as it should do, exactly as it should do. Now, the next target for me, and who knows, we could be halfway there by the time the non-farm payroll number comes out by the looks of it, is at 120.60, 120.50. Well, actually, do you know what? I'm going to call it 120.60. I'm going to call it 120.50, 120.40. And the reason for that is it's a 38.2% fib, which ties in nicely with that previous swing low. And the 500 period moving average on the 4-hour chart. It's a good moving average. It's a big one. So watch for that. That's the next target and the next big support level for today. So if that's tested and it holds, then the bulls are okay. We've just had a small correction in a bull trend. If we close the week below 120.40, I would suggest that that's going to be more of a problem. Actually, do you know what? That's 120.24. So 120.50, 120.40 is the support level. If you're trying along there, I would suggest you want to stop below 120.20. It's a small risk reward. It is a good support level, but if we close the week below 120.20, that's more serious. That is really starting to put the bears in the driving seat here. So those are your big levels today. Nice, because the levels are about 80, 90 pips apart, and that's what you want. You want to see some decent moves, and holding the support level, the resistance level could well see us test that. Now, here's another interesting point. The trend line, which goes back all the way to the beginning of April, or the end of March actually, really worked very nicely. I showed you how many times that this trend line had been tested, and look how nicely it worked as resistance. Again, once it broke support with a nice big red candle, just to show that it really has significantly broken it, we bounced very kindly. The market just gave bears an opportunity to sell into a short position, bang on the 50 period moving average, bang on the trend line, nice shorting opportunity, and then we broke the 100 down to the support, what I thought was a good support level, but it broke and then down again. So, you know, keep those trend lines on, and remember, when a support level is broken, it becomes a resistance. Now, we're about to get a moving average crossover by the looks of it. I've talked about this during the week. We're about to get a potential negative moving average crossover. We could see that before the end of the day on the 4-hour chart with the 50 period moving average crossing below the 100. I'm sure we already have some negative crossovers on the 1-hour chart. Yes, we do, of course. 50 crossing below the 200 and the 100, and now even below the 500. So negativity creeping in. Would not be at all surprised to see the test of that. Now, another reason why this level is extremely important. Have you seen this on the 1-hour chart? Let me just grab this. Right. Sorry, not the 1-hour chart, the daily chart. There we go. Daily chart. Now look. 120.50, I've talked about it, 120.50, 120.40. We've got the 50-day moving average down there, and we've also got the 100-day moving average, which is far more significant, down at 120.40. So 120.50, 120.40 really is the big support level of the day. If you think that the bulls can win this over, don't forget, we are still in a bull trend. Potential double top maybe, but, you know, trade in the direction of the trend, and the trend clearly is still up. Even this down here was just a correction. We held the 38.2% fib perfectly. Will we hold this 38.2% fib perfectly and then bounce off it? Right, I think I've probably said enough about the euro. I've spent a lot of time on the euro US dollar today because the euro is the biggest. How can I put this? It's got the biggest weighting in the dollar index. So if you want to really capture a move in the US dollar, it's really the euro US dollar that you want to be trading. That has the greatest effect because the euro, I think, makes up about 40% of the dollar index weighting. So that's the one you really need to watch. Okay, cable. Let me just scrunch it up a bit. Cable, we've got that double top. Cable didn't react as negatively as I would have thought yesterday when you bear in mind how much the euro dumped. However, we are breaking that 23.6% fib at last. So we are seeing some negativity creeping in. Let's have a look at the 4-hour chart. There we go. Right, this is what I've been looking for, obviously, with that double top sell signal. First test, we held a 23.6% fib. Okay, fair enough. That's to be expected. Then we've bounced, and now we've turned lower. Now we've broken that support at last. Now this is significant. We've just broken the 500 period moving average on the 1-hour chart. So it's the 500-hour moving average. We've broken lower. We're starting to get some negative moving average crossovers here. So this is all playing out nicely. This is what should happen. We should be seeing this with the double top. Now I could even argue that this is, I can argue this. I can argue that this is a head and shoulders pattern just on the hourly chart, so it's not massively significant. Whoops, I've misdrawn that trend line. But still worth noting. Now here we go. There we are. I could certainly argue that somewhere around here is the left shoulder. I'm not sure which bump you want to call it, but then you've got the head, then you've got the right shoulder here. So yeah, definitely looks like a head and shoulders pattern. Now we've broken the neckline, which just is beautifully bang on that 23.6% fib and 500-hour moving average. You can see we broke it, tested it, and now we're heading lower. So this pattern alone, even disregarding that huge double top pattern that we've got on the daily chart, this pattern alone is very negative. We've got a peak at 142.50. We've got the neckline at 141, call it 10. So I'm going to call that 140 pips. When you project that lower from the neckline, 140 pips from 141, what am I looking at? 141.15. Okay, so we're looking at, my maths isn't very good, 40.75, 139.75, something like that. So we could be looking at a move as far as 140. Yeah, we could be looking at a move as far as the 50% fib down here. So this really is looking quite negative for cable. We do need a strong non-farm payroll number to help me along with this theory. But of course, we now have very strong resistance at 141.10, 141.20. If you want to try a short there, I would certainly stop above 140.40, which is the 50-hour moving average. That should be safe, pretty low risk trade. The first target is 140.30, 140.20, and we could certainly be as low as there we go. This is my target. I like this. So eventually, no, sorry, that's way too low. Eventually, we could certainly get to the 50-day moving average at 135.60. That looks like a reasonable target just for that little head and shoulders pattern I showed you on the hourly chart, and certainly for the double top pattern. Now, I'm just going to show you here. Whoops. Just going to show you. This is your first target. This is, let me just grab that. This is your first target, 140.30, 140.20. I showed it to you on the 4-hour chart. Also coincides quite nicely with my trend line here. So that is your first target, your first support level for the day. If we happen to hit that this morning before the non-farm payroll number, admittedly that's about 70 pips lower, that would probably, there's a very, very strong chance that will be a low for the morning. Whether it holds over the non-farm payroll number, I do not know. But eventually, I would not be surprised to see the market hit 139.60. Not saying that's going to happen today, but on a strong non-farm payroll number, we could certainly hit that beginning of next week. Right. New Zealand versus the US dollar, the Kiwi. This has been more of a confusing picture, I have to be honest. There's no pattern here that I can decipher clearly. So I'm not going to spend too much time on this one. The technicals are not easy to read. However, again, quite negative, surprisingly negative. During the week, I said to you that the dollar has seen gains on economic releases, inflation, whatever, recently, and that the dollar has been pumped up and quickly retreated. In fact, often on the same day, you've seen the dollar have a serious pump up on a CPI or a PPI number and collapse by the end of the day. Now that has not happened this time. As we wait for the non-farm payroll number. So maybe this is more significant. Maybe dollar bulls are actually starting to get a foothold in the market. We'll see by tonight's close and the reaction on the non-farm payroll number. But for now, we can see that the Kiwi has broken below the 38.2% fib, which I suggested yesterday would be a strong support level. Now, my reason for that was a very short-term trend line, not majorly important. But more important was a 38.2% fib. Let's have a look at it on the 4-hour chart and the 100 period moving average. So normally that really would be a decent support level. So it just shows how strong the reaction in the dollar was for us to break that level. Now that therefore leaves us in a situation where this pair has got more of a negative outlook, having broken such strong support levels. I'm actually going to go to the 4-hour chart. There we go. Now, on the 4-hour chart, again, significant. Look, we had the 500 period moving average on the 4-hour chart at that support level, as well as the 100-day moving average. So really, really was a big level, and we just sailed straight through there. Just shows that the weakness is here. This is obviously going to be the strong. Now, we've hit the 50, bounced just below it. If we get as far as the this level, which is 71.70, 71.80, that is obviously the key resistance level of the day. Now, whether it holds on a week non-farm payroll number, I don't know, but if we were to bounce there this morning before the number, I would suggest that could very well be a high for the morning. We're only about 20 pips off it, so watch that level. Okay, I didn't want to spend too much time on that. Canadian dollar has been in a consolidation period. Now it's breaking a little bit higher. I'm not convinced this is the start of a big bull move, but there are some levels that you need to be aware of for the non-farm payroll number. Same levels as I said yesterday. So here we go. Oops, that's not what I meant to do. Right. Now we've broken above this little trend line here. Just goes back a few days. So that's mildly bullish, but we still have quite an important, let me get my crosshairs back. We still have this trend line here, which goes back. Okay, so these trend lines are back to the 14th of May. They're 2 weeks old, not a big deal. But the fact that we've broken this little trend line, yes, okay, we can trade higher. We can trade up to the previous highs over the last 2 weeks at 121.40. And we've also got the 23.6% fib at 121.60. So for this morning, 121.40, 121.60 is your main resistance level. Now, that could be the high for the day if we don't get a ridiculously strong unemployment number. If we do, we could reach as far as 121.95, 122.05. Now that is a real big trend line, very important level. This trend line, I can't even show you on the 4-hour chart. So let me go back to, just note that the 200 period moving average on the 4-hour chart is also around 122.00. So that lends extra weight to that level. Now, I wish there was a fib level there. There isn't, which is a shame. Ah, yes, there is. Ah, yes, there is. No, there isn't. I'm looking at 122.00. Okay, so 122.00. It's a little bit higher than my 23.6% fib on the daily chart. Okay, let me scrunch this up. Okay, there we go. There's our trend line. It goes back to 1st of September. It's a significant trend line. Goes back quite a long way. That's up around 121.90, 122.00. Coincides with that 500 period moving average on the 4-hour chart. That's probably the bigger resistance than 121.40, 121.60. But there's a lot going on. I can't see anything particularly bullish, actually. You know, despite a good recovery in the dollar against the Canadian yesterday on the back of that number, there's no pattern here. There's nothing. You know, okay, maybe that's a bullish engulfing candle, but we hadn't made a new low. If we'd have made a new low and then got a bullish engulfing candle, I'd say, wow, bear trap. I just can't put my finger on anything that would really make me want to buy this at the moment. So although there is some dollar strength, I'm not 100% convinced. Certainly not in that pair. Dollar Swiss. Now this is a beauty. This is working really nicely. Let's first look at it on the daily chart. So I talked about this resistance level, and I didn't actually think we'd see it, to be fair, but we have seen it. We've broken above this little short-term trend line. We are now hitting the 23.6% fib, which is at 90.50, 90.60, and we also have the 200-day moving average, which comes in at around 90.70. So anywhere from 90.50 to 90.70 is a big resistance level for the dollar Swiss today. We are going to have to see a very, very strong employment number, I should say, a lot of jobs created in order for us to break that. Now, if we close the week above 90.70, that would be pretty positive. So watch that level. If you think that the non-farm payroll number will not be strong enough to break that, then there's your bigger resistance level. If we close the week above 90.70 and you are short, well, you know, you want to be out of your short if we close above 90.70, because we could certainly see further strength next week. Again, 4-hour chart is also showing us a 200 period moving average on the 4-hour chart coming down there as well. So a lot of resistance around 90.50, 90.70. That's your big resistance level of the day. That's going to be key for the direction into next week. We close above 90.70, it's bullish for next week. We close below 90.50, it's going to be negative for next week. Right, where are we? Dollar versus the South African rand. For some reason, this has grabbed my attention. I'm just going to show you. We had a very small bounce. That's not a bullish engulfing candle. We did make a new low, and we've closed halfway up the previous red candle, so mildly bullish again, but I don't see that as a buy signal. I'd have to see, it's a weekly close. I should be looking at some of the weekly charts as well. Yeah, we would have to see, no, we can't get a weekly bullish engulfing candle. We would have to close well above 1400. Now, one of these markets did have potential bearish engulfing candle. Here we go. Yeah, if I remember correctly. Back to the euro US dollar, sorry. Nope, that's not a bearish engulfing candle. Forget that. Just check your weekly charts, because if we get a bearish engulfing candle, by which I mean a new high followed by a lower close on the weekly charts, that would be very significant. I think it was gold. I'm sure I saw something along the lines of a bearish engulfing candle. Yes, here it is, gold. Right. This is quite significant in gold. Sorry, I've jumped to gold, but I just jumped into my mind. Now, I talked about some weakness in gold. I talked about a bearish engulfing candle on the daily chart, and I warned you that we could trade lower. I did say that it's probably just a correction in the bull trend. I didn't say it was a sell signal. Selling into a bull market isn't the cleverest thing to do, but this could change everything. Now, we had a new high this week. This is the weekly chart. We had a new high in gold. We got up to 1916, and we've reversed. Now, not surprised that we reversed because of the bearish engulfing candle on the daily chart, but we broke the first support level at 1880. That was a good support level yesterday. It broke. Now, we're holding below there. We hit the next target, and I'll show you on a shorter term chart. But this is what's important. Last week's low was at 1872. If gold closes the week below 1872, which is where we're trading right now, we have a bearish engulfing candle on the weekly chart. That is more significant, and I'll tell you another reason why that is more significant. There we go. Right, this is the weekly chart, remember. 61.8% fib resistance at 1923. That was my target for this week. We fell short of that by about 7 points. We only got to 1916. So we failed at that resistance level. We got a bearish engulfing candle on the daily chart. We now have a potential bearish engulfing candle on the weekly chart. This is not good for gold bulls. Not good at all. We closed below 1872. That's not going to be helpful. We closed below yesterday's low. That's going to be pretty significant. That's going to hurt. So I couldn't say to short gold just on this minor negative candle, but I did warn you that it was a minor negative candle and that we probably would see a correction or at least a bull flag form. So that's pretty much the best I could do. I can't suggest selling into a short position on a bull market. That's just crazy. Now, we broke what was still a good support level around 1882. Now, 1860, I think I did point this out to you yesterday. 1860, there's your 38.2% fib, and there's your trend line going all the way back to the end of March. Nice. We held it. We got as far as 1855, and we've bounced. So that level really has held, 1860, 1855. Let's look at it on a shorter term chart. Let's look at it on the 4-hour chart. Now, there is a lot of support here. Now, where do I open this up? Okay, actually, here we go. Right, I think I did show you this yesterday. I'm pretty sure I did. Okay, I can't get that on there. Anyway, you can see What am I trying to show you? What am I trying to show you? Okay, so yeah, we've just about held these trend lines around 1860, 1855. If we get any lower, now then, let me just jump onto my notes here. So that level is held. And look, actually, on the 4-hour chart, look at that nice bullish candle. Can you see that? That hammer. We spiked down on the 4-hour chart, tested the support, bang, straight off it. Nice small red body candle near the top of red body on the candle near the top of that long lower wick, showing that aggressive buyers came in. Now we've got a green candle. So at the moment it's all looking good. But the question is, what do we do around 1880, 1885? Do we hold that and then potentially start a short-term bear trend? Bear trend is a series of lower lows and lower highs. If that does hold, we might start to have a series of lower lows and lower highs. Right. If we get lower today, we've got the 200-day moving average, which is around 1845. Here we go. 1845, 1840. This is the 50% fib, the 200-day moving average, and where's my trend line? Where's my trend line? There we go. Trend line going back to August. It all comes in around 1845, 1840. So that really is a good support level today. Yeah, that's really all I can say. 1860, 1855, 1840, 1845, 1840. They're the big support levels in gold today. Really, any weakness you really probably should be looking at along around 1845, 1840 if you are a gold bull and you're looking for a good buying opportunity, because look at these swing highs up here. They really held very well. That swing high is 1845, that swing high is 1843, that swing high is 1843. So 1845, 1840 really is a really big support level. So if you are a gold bull and you are looking for an opportunity to buy into a long, that would be a gift, I would imagine. Certainly would be a low risk trading opportunity, and you could stop out below 1835, risking 5-10 points maximum. And if the bulls do jump in there, then we could even be back up at 1900. Okay, how am I doing for time? Whoa, I'm really running over time. Right, I'm going to quickly jump to the yen. I've been talking about yen weakness all this week. We haven't seen any weakness in the CAD yen, but it certainly is holding. So for me, that's just a consolidation period. The euro yen's pulled back a little bit because of that euro weakness. So we could drift a little bit lower. When you look at it on the 4-hour chart, the euro suffered, obviously. I think it's really the dollar's strength that's pushed the euro lower, but we could get down as far as 133.00. Who knows? It's 40 pips away. It really is absolutely key, 133.00. It really must hold. If that holds, then we can continue higher. New Zealand dollar versus Japanese yen, that's probably weakened because the Kiwi took a bit of a bashing. It has done. I'm not going to focus too much on that. Dollar yen, obviously yen did weaken against the dollar for obvious reasons. So that looks pretty good too. I like the fact that we're now through this trend line. So still favoring yen weakness. I was wrong about the dollar weakness, certainly, and that all comes down now to the non-farm payroll number. Right, so yeah, holding above 110.00 looks quite positive for the dollar yen. I think that's it. Crude, still looking strong. Happy with crude, nicely actually, just trading on its fib levels. If you're trading crude, put your fib levels on there, put your little short-term trend line that I had on there yesterday. So we've dipped to the 23.6% fib. Do you remember how I broke those fibs down? I broke them down from the previous swing low. Then I took another set of fibs from the 61.8% low. Now that gave us a fib at 68.20. That seems to be holding perfectly. We've got a little trend line just going back to the 27th of May, so it's only a week old. That's also lending some extra support there in oil. So at the moment, oil looks pretty good for the bulls, definitely in a bull trend. So that is fine. Okay, I think that's it for today. NASDAQ. Stock markets took a bit of a hit. Stock markets took a bit of a hit because there's that lingering concern about higher interest rates. Higher interest rates really are probably the biggest driving factor for the US dollar, and they're also very important for stock markets, especially these days with them being pumped up on QE and low interest rates. So any change in that QE situation or a potential rise in interest rates could significantly impact the stock markets. And I'm still looking at this potential head and shoulders pattern. It is playing out, but I'm not going to be negative until we break the neckline at 13,100 in the NASDAQ. So again, it's just a situation I'm monitoring. But if that does play out, that will be quite a significant trading opportunity on the short side. Right,